Good afternoon and welcome to the RICARDO PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And then I'd like to hand you over to Graham Ritchie, CEO. Good afternoon, sir.
Thanks, Lizzie. Hello and welcome to the interim results of RICARDO for 24-25. As always, before we start, please take a moment to note the disclaimer statement. So consistently with how we've managed the agenda previously, I'll start with a few opening remarks and Judith will then take you through the financial results. Given the performance of the group in H1 and the outlook shared following the trading statement, I will then spend a little bit more time going through the strategic update and the operational progress. The first thing to say is that we're very pleased to have completed the divestment of defence business in the US and the acquisition of E3A in Australia. As you'll see shortly, the 23-24 represented the expected peak in performance of the RICARDO defence business based on expected reductions in the ABS project. And we therefore believe we have achieved the right timing of the sale of defence business at very good value. Despite the short-term headwinds and macroeconomic uncertainty, we've delivered a very good profit improvement in H1. Within our energy and environmental business, the performance in H1 has been behind expectation, mainly as a result of more significant impact from global elections. However, as I will explain shortly, with very good confidence in the medium term due to the resilient solutions that are needed for the longer term, and we have the highest backlog ever. In automotive and industrial, we continue to see variability in orders as customers delay investments in emerging solutions. However, we have seen good growth in our industrial market segments over the last few years, following our deliberate diversification to these markets to mitigate against continued challenges in automotive. We've made good progress in our cost base and operational efficiency over the last 12 months, but we also recognise as a smaller business following the divestment of RICARDO Defence, we have more to do to underpin our short and long-term profitability. The bulk of the presentation today is focused on the go-forward continuing operations, but I wanted to start with a split of continuing and discontinued operations to demonstrate why we believe we have delivered against our stated strategy and managed the timing of the sale of RICARDO Defence well. As expected, 23-24 was the peak of the defence revenue and profit, with about 75% of the profit being generated by the finite project on ABS, which was expected to materially come to an end in fiscal year 27-28. In addition, more CapEx would have been required to develop new programs. Revenue has declined 25%, profit by 50%, and margin by 640 basis points compared to H1 last year. Without the divestment, the defence business would therefore have been a material drag on the performance of the go-forward business. More importantly, the divestment demonstrates the successful execution in line with our strategy to simplify and transition the portfolio to provide long-term resilient solutions in energy transition and environmental adaptation. We've consistently communicated our objective of delivering more than 75% of our profit generated from our environmental and energy transition portfolio. The successful divestment and the immediate back-to-back use of the funds with the acquisition of E3A has enabled this key milestone, and again demonstrates our ability to deliver on the strategy and acquire attractive businesses at good multiples in competitive markets. The acquisition mitigates some of the short-term dilution, but more importantly, improves the long-term quality of earnings. E3A delivers immediate high growth margin accretion with operating margin above 20%. It also adds to our strategic advisory capability for large infrastructure projects in rail, wider transport, water and energy, creating revenue synergy, combining our advisory capability and technical solutions to create incremental value for our customers. I'll now hand over to Judith to take you through the key financials for the continuing operations.
Great, thanks Graham. Good afternoon everybody. I'm now going to take you through the results for the first half of FY25. This is our usual KPI slide, which shows the performance of the continuing underlying business on a constant currency basis. You'll see our order intakes up 11% at 221 million, and that reflects us securing some large long-term multi-year programs, mainly in our energy and environment business. If you strip those programs out, our underlying order intake's up around 5%. As you're going to hear from Graham and I throughout today's presentation, we have faced some market headwinds. So as a result, we've seen a bit of a delay in the timing of those orders, either into the latter part of H1 or some into future periods. So as a result, we've delivered modest revenue growth of 2%. However, we've made significant improvement in our profitability, and we've taken actions to reduce our cost base. So as a result, our operating profit margin's up 430 basis points to 4.9%. That gives EPS of 4.7p, up over 200% on last year. Our net debt's reduced by 41 million since June to just under 19 million. That gives leverage of 0.6 times. It reflects the proceeds on the sale of the defence business, but doesn't yet reflect the cash out on the acquisition of E3 Advisory. If that transaction had completed on the 31st of December, our leverage would have been 1.4 times. And as you'll hear from me in a few minutes, we have seen slightly lower cash conversion than we expected in the first 6 months, and that's really down to timing of a receipt and some rephasing of our invoicing milestones. And then we're declaring an interim dividend of 1.7p per share. That's in line with our dividend policy of maintaining cover of 2.5 to 3 times and paying just under a third as an interim. So we've made really good progress in our continuing business, but because of those short-term market headwinds, we've delivered just modest revenue growth of 2%. However, we've delivered a significant improvement in profitability, with operating profit up 7.3 million to 8.3 million. With actions we've taken within our A&I business to reduce our fixed resource base and use more variable resources, with improved utilisation in many areas of the group, particularly within energy and environment, and with continued good delivery of our projects, we've seen our gross profit margin up 200 basis points to 30%. And then with the actions we've taken to centralise our enabling functions and reduce our indirect costs, we've seen our indirect costs come down by over 3 million. They now represent 25% of revenue, and that is higher than our 20% target, but that reflects us removing the revenue from defence and not yet including any revenue on E3 Advisory. We knew in the light of the sale of our defence business, we'd need to right-size our indirect costs. We made good progress in the first half, and as we go into the second half, we'll see increased revenue. We'll see the inclusion of the revenue from E3 Advisory, and we're going to continue to focus on managing those costs. So I expect to see some improvement in that percentage. And then going forwards, we're continuing to look at right-sizing those indirect costs to remain on our path to our 20% target. So that gives operating profit up 7.3 million to 8.3 and margin up 430 basis points to 4.9%. Our net interest costs are broadly in line with last year, and our underlying tax rate at 29% is, as expected, up on last year, and I expect to see that continue to trend towards 30% as we see increase in profits from higher tax jurisdictions, particularly in Australia on the back of the E3 Advisory acquisition. Looking now at the performance of our individual business units within energy and environment, our order intake's up 24%. That reflects those multi-year programmes, and if those are excluded, our underlying order intake's up around 10%. However, as you're going to hear from Graham, we have faced some market headwinds, particularly around the timing of elections, but also some disruption within the water markets we operate in. So as a result, our revenue's down 4% and our operating profit's down 14%. However, we've got resilient offerings in this area, and we've seen a significant increase in our order book that's deliverable within the next 6 months. So expect to see improved performance in the second half, and overall for the full year, expect to see our performance broadly in line with last year. We've made progress in driving up utilisation in the first half, and with increased revenue in H2, I expect to see further improvements, which will drive back up that margin. In rail, we entered the year with a good order book and a strong pipeline, and that's enabled us to deliver order intake growth of 10% and revenue growth of 2%. We're seeing particularly good growth in our core growth markets of Asia and North America, but more subdued performance within Australia, where we're operating in a more mature market. That revenue growth, along with actions we've taken to reduce our costs, means we've seen our margin up just above 12% and a 15% increase in profit. As we go into H2, I expect to see continued good performance in Asia and good performance within Europe. But I do expect to see some reduction in revenue in North America as a result of our element of the California high-speed rail project being deferred. So overall, again, I expect our total performance for the full year to be broadly in line with last year. And then in the emerging A&I business, we continue to see volatility within our markets and delays in order intake. We're also seeing internal combustion engine for longer, and hence more of a switch to our established A&I business than we expected. So as a result, order intake and revenue is down on last year. But with the actions we've taken to reduce our fixed resource base and use more variable resources, and also reductions in indirect costs, we've delivered a profit of 1.5 million, up significantly on last year's loss. And that gives a margin just under 8%. However, with the ongoing uncertainty around the timing of order intake and also that switch to ICE for longer, means we've taken a more cautious view around our future cash flows in this area. And hence, as a result, we've impaired the goodwill in this business, and that's resulted in a 14 million non-cash write-off within specific adjusting items. Our performance products business, order intake broadly flat on last year and revenues up 6%. Revenue and volumes within our powertrain business are up fractionally on last year, but as we expected, we've seen a reduction in volumes in transmissions as two of our key programs are coming to an end. So that revenue growth has really been underpinned by pass-through revenue on our new framework agreement, where we get limited margins. However, in the first 6 months, we were able to recognise a one-off profit on this project as we closed out our calendar year 24 activities in a more efficient manner. So as a result, our profit's up 800k on last year. As we go into the second half, I expect to see that revenue growth continue to be underpinned by the performance on that framework agreement, and hence I expect our revenue to be just fractionally down in H2 compared to H1. And then in established A&I, as I've already said, we've seen demand for our ICE capability. We've also been supporting the performance products business on that new framework agreement. So as a result, we've seen really good increase in order intake and revenue, but those projects do have quite high material content and hence slightly lower margins. So despite some strong improvements in our cost base, we still delivered a just below break-even position, but that's over a 3 million improvement on last year. As you know, we run our A&I business as one, so this just looks at the combined results for the total A&I business. And here you'll see our order intakes up 3% and revenues up 5%. And from those actions we've taken to reduce our fixed resource base, use more variable resources and reduce our indirect costs, we've delivered a profit of just over 1 million, which is up over 5 million on last year's loss. As you heard from Graham earlier, with the sale of defence, we've simplified our business and seen a shift towards our environment and energy transition portfolio. As a result, that portfolio now represents over 80% of our operating profit. Also on this slide, you can see the actions we've taken to reduce our indirect costs means our central costs have come down by 1.8 million to 7 million. Looking now at our cash performance, we entered the year with a net debt of 59.6 million, and that's reduced to 18.5 million. As you can see from this waterfall chart, the main movement there is the receipt of the proceeds on the sale of defence. Our continuing business delivered cash from operations of 1.2 million, representing EBITDA of 14.4, offset by a working capital increase of 13.2 million, and that gives cash conversion of 13%. I always expect our cash conversion to be lower in the first half as we have a number of annual costs and we pay the bonuses in respect of the prior year. But this is lower than we were expecting, despite a rigorous focus on working capital management. And that's really been driven by two key factors. One, the receipt of our R&D tax claim that last year we received on the 31st of December has been deferred into the second half this year, and that's around 6 million. But also we've seen some lengthening of our invoicing profile. In our A&I business, we have a number of projects that we are working this year and are coming to an end, where we receive money up front at the start of the project, and hence in prior years. And then in our rail business, we're seeing an increase in work in Asia, where we see longer gaps between invoicing. We've seen good cash collection from our debtors, and our focus now is on improving our invoicing. That's right at the very start when we get the right cash terms on bids to ensuring we deliver our project milestones on a timely basis to enable timely invoicing. We've seen improved invoicing in Q2 compared to Q1, and with that rigorous focus, I expect to see improved performance in the second half, and along with the collection of the R&D tax claim, expect to see improved cash conversion. And then you'll see our defence business, we had a cash outflow of 3.1 million. That represents two facts. One, our main receipt from our key ABS client was deferred from December into January. That's now been received, and the purchaser passed that on to us as part of a working capital adjustment. But also we've seen some build-up of inventory on long lead time items. So that reduction in net debt meant our leverage came down to 0.6 times. That's well within our covenant limit of 3 times and below our target of 1.25 times. However, that didn't yet reflect the cash out on the acquisition of E3 Advisory. So I expect to see our net debt increase in the second half. And if that transaction had completed on the 31st of December, our leverage would have been 1.4 times. And then we have in place a 150 million RCF facility. At the end of December, 38 million of that was undrawn. And because of the proceeds on the sale of defence, we had a large cash balance of 93 million. So we've got really good headroom on that facility. That facility does end in August 26, so we'll be looking to refinance that in the second half of this fiscal year. And then we entered the half with a really robust order book at 393 million. That's up 13 million on last year and up 37 million on June. You can see from this, that securing of those multi-year programmes has lengthened our order book. And we've also, our order book deliverable in the next 6 months at around 163 million is up on June by around 13 million, but is a fraction down on December. If you look at that by our business units, you can see a significant increase in our order book in energy and environment on the back of those multi-year programme wins. And that really shows the resilience of our offerings. You'll also see the order book deliverable within the next 6 months is up both on December, but also on June. So again, that gives us confidence as we go into the second half. In rail, you'll see our order book overall is up on last year and also on December. An order book deliverable in the next 6 months is up a little bit on June, but is down a fraction on December as a couple of project wins within our Dutch business have been delayed just into January and February. And then in our A&I business, you'll see our order books reducing as we work and complete some projects from last year, but also because of the delays in that order intake. Since the half year, we have been notified of a couple of wins, and when those contracts come through, I expect to see an improvement in our order book. So we delivered really good progress in improving our margins in the first half. As we go into the second half, we're going to continue to focus on the control of our indirect costs, and we'll be driving further improvements in utilisation as we see increased revenue and we continue to use flexible resources. As we go forwards, we're going to continue to reshape our indirect costs post the sale of defence to ensure we're on that path to a 20% target. But also, as you're going to hear from Graham, we're also focusing on driving up more revenue from our higher margin recurring and digital revenue streams. And we will be continuing to review our portfolio transition. Our cash performance in H1 was not where we wanted it to be, so we've got a laser focus in H2 around the delivery of monthly invoicing and collections, and particularly on invoicing, identifying opportunities to accelerate invoicing milestones on existing projects, but also ensuring we get the right cash terms in our bids. So with improved invoicing and that receipt of the R&D tax credit, I expect to see improved cash performance in H2. Going forwards, we're going to be continuing to drive that operating cash performance. We'll be reviewing the size and shape of our CapEx spend, given the revised shape of the group. And as you're going to hear from Graham, we've got some significant spend coming in our performance products business on our new framework agreement. And we're looking at options around phasing and funding that CapEx. And with that, I'm going to hand back to Graham to talk about the markets.
Thanks, Judith. So key to our long-term strategy is the high-growth, high-margin energy and environmental business. It's worth noting that we have delivered on this strategy to date, doubling the profit of this business since 21-22. As Judith mentioned, we've seen good orders and order book development in H1 for our energy and environmental business, However, we have not seen the expected flow through to revenue and profit in H1, given the timing of orders. The geographic split and client split show that we currently have 64% of our orders generated in the UK and Europe, with 72% from public sector. This combination means we've had a disproportionate impact by the UK and European elections impacting the timing of orders. Australia at 13% still has got federal elections to come, and we're seeing similar delays in some water orders as a result. We were clearly expecting some delay in orders as a result of the elections, but particularly in the UK, we've seen the delay of the spending review to June of 2025 that has created extra delays in project decisions. Notably, we have only 5% in North America, so we're less exposed to any uncertainty created in environmental policy following the US election. With the two graphs on the right, you can see that 70% of our orders support environmental adaptation and 30% support energy transition. This is supported by the fact that water, air quality, and policy strategy and economics make up more than 75% of our business area mix. These are services that are required regardless of the pace of energy transition. With increased demand for energy, we're also seeing a high growth in our power planning solutions, particularly focused on industrial decarbonisation, where customers are looking for cost reduction and energy resilience from renewable energy sources. The one area we are seeing some longer term headwinds is in corporate sustainability, but this represents only 6% of our orders mix. As mentioned on the previous page, we have seen short-term headwinds from particularly the global elections and perhaps a more permanent challenge to corporate sustainability. However, we continue to see medium-term tailwinds that support our long-term growth. In air quality, we are the leading provider of air quality solutions in the UK with a strong long-term order book. We see significant opportunity to expand internationally into Asia and the Middle East with both public sector and corporate clients. In our key water segments of the UK and Australia, there is a large investment required with aging infrastructure and increased population demands. The key focus is to provide advisory support on the optimal use of investment with the utilities. In policy, we're seeing increased demand globally for climate risk and adaptation solutions. This gives us opportunity to expand both internationally and more in the corporate sector as well. With increasing energy demand globally, we see an opportunity to accelerate the take-up of the digital application for power planning across Europe. This is required by financial institutions, utilities, and high users of energy to support their investment decisions in new infrastructure. Whilst there is a challenge in some ESG solutions, there is still demand for supply chain resilience and circularity solutions that provide longer-term economic benefit. Within automotive and industrial, we've made good progress in returning the business to profitability in the first half, following the change in the operating model and a shift to a more variable resourcing model we introduced last year. Judith has also shown the importance of our strategy of being technology agnostic and supporting our customers with both established and emerging solutions. We've not seen the growth in the emerging solutions we expected over the last few years due to geopolitical uncertainty, higher interest rates impacting levels of investment, and higher inflation impacting consumer take-up. However, this has been offset to some extent by our established solutions, where we've seen a general trend of industrial internal combustion engine for longer. On a combined A&I basis, we've delivered a 3% order growth, 5% revenue growth, and a 5 million profit improvement in H1. We've also talked about our proactive diversification into new markets of industrial, being aerospace and defence, marine, and off-highway, to offset the declines and the variability in orders from automotive. In 2022, the industrial segments made up just 25% of the A&I mix, with 75% coming from the traditional automotive sectors enjoyed by Ricardo in the past. We've delivered good growth in the industrial sectors over the last 3 years, and in H1, the mix of our orders for industrial makes up about 60% of our orders, with automotive just 40%. We see good opportunity to continue this trend with growth in our industrial segment going forward. Within rail, we've seen good margin accretive revenue and profit growth, with margins now at circa 12%. I've talked previously about the importance of our proactive sales and diversification of our rail business. This is because historically we've enjoyed success in our traditional mature markets of the UK, Europe, and Australia. However, these mature markets are increasingly challenged on funding from national or state governments, meaning there are fewer large infrastructure projects available. Instead, focus is more on operational efficiency and reduction in maintenance costs. We're therefore focused on continued development of our signalling capacity and pivoting our solutions to operations and maintenance. We do see good potential for growth in North America, Asia, and the Middle East. These markets have opportunity for good growth in both metro and high-speed rail between cities, where we provide safety assurance and systems engineering for both rolling stock and signalling requirements. Following the fires in California, our work on the high-speed rail project has been deferred. We're hopeful to recover some of this lost work over the next 12 months with additional projects working with partners in the US. Performance Products has had a solid first half within the automotive driveline and assembly business. However, with a couple of the driveline projects coming to an end and the powertrain volumes expected to continue to be down in the second half, we've again looked to diversify away from the automotive sector. The new marine framework agreement that we announced last year continues to progress well and is expected to create significant value for Ricardo. Whilst there is an initial investment by Ricardo of circa 20 million, the net cash investment on the project is only 5 million, as we have contracted the customer to pay 15 million back to Ricardo at the start of production in fiscal year 27-28. The return for Ricardo is therefore expected to be many times the initial net investment, creating long-term value for Ricardo. So bringing all of this together, we're very clear on how we create value for each of our business units. Within EE, we have a leading capabilities and resilient solutions that we're looking to scale in new geographies outside of the UK and Europe, and we're also increasing our private sector mix. We're also increasing the strategic consulting capability to create differentiated value by combining our strategic and technical consulting, as demonstrated with the acquisition of E3A. Within rail, we continue to diversify into new growth markets and pivot our solutions in mature markets to focus on cost optimization in operations. Within A&I, we continue to focus on growing new customer relationships in industrial segments where we're seeing good growth and creating cost and operational efficiencies for the automotive sector. And within PP, we're focused on creating significant returns on the net investment from the new framework agreement, whilst maintaining our existing automotive programs. For the EE, rail and A&I business units, they're connected by the need globally to align policy, transport, and energy and environmental infrastructure to adapt to climate change. Ricardo is developing digital and engineering IP that can support these interrelated complex challenges and create more resilient recurring revenue streams for the future. Much has changed in the macroeconomic and geopolitical situation since we set out our original May 22 ambitions. However, as we look forward, albeit from a lower base, we expect to deliver strong profit growth over the next few years. We expect our EE business to deliver double-digit revenue growth with mid to high teens margin. Rail is expected to deliver single-digit growth and double-digit margin. Automotive and industrial is expected to deliver single-digit growth and trend towards high single-digit margin. Performance Products is expected to deliver single-digit revenue growth with mid-single-digit margin performance. This all blends to a group revenue growth of mid-single digits and expected margin improvement trending towards 10%. Our other targets for the group of cash conversion, capex, dividend, and leverage remain unchanged. So to summarize, in the first half, we've demonstrated good progress in delivery of the strategy to reposition the portfolio of the group, having divested the finite profitability of defence and replaced it with a high quality of earnings for the long term with E3 Advisory. We remain confident this creates long-term value, with more than 80% of our profit now generated from environmental and energy transition solutions. We've delivered strong year-on-year profit improvement within the A&I, now profitable and showing 5% revenue growth. The changes we've made to the variable resourcing model mean we can now more effectively manage the variation of the timing of orders. H1 performance is also supported by continued strong focus on cost management, and we can also take confidence from the strong order intake and order book, particularly in EE and rail. There remains some uncertainty in our own markets, which is creating delays in order timing, and as a result, we're laser focused on cash management and minimizing costs to mitigate any challenge in the timing of orders in H2. However, we're also increasingly prioritising both our portfolio and market focus to deliver more resilient order intake and revenue. The transformation we are undertaking is complex with many variables, but despite the short-term market headwinds impacting our order timing, we remain confident in our strategy, medium-term outlook, and expect to deliver strong profit growth over the next few years. That's it for the presentation, and I'm happy to now open up for questions.
Graham, Judith, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our Investor Dashboard. As you can see, we have received a number of questions throughout today's presentation, and if I could just hand back to the team to read out the questions and give responses where appropriate to do so, I'll pick up from you at the end.
Okay, so the first question, how do you get to the new 10% target and what will be the main levers to get there? And subsequently, do you need the market to come back to get A&I as a whole to get to a double-digit margin?
In terms of getting to the 10% target, as you heard from me a few minutes ago, one of our main focuses at the moment is around reshaping our indirect costs to maintain on that path to our 20% target for indirects. That gives a large uplift in our margins when we achieve that. Also, a few minutes ago, and Graham picked up as well, we are focusing on revenue from those higher margin revenue streams such as digital and IP revenues. So again, that will shift the mix of our revenue streams to higher margin activity. And then we've made the acquisition of E3 Advisory, which again is a high margin business. So as we see growth from that business and within our energy and environment business, as Graham said a few minutes ago, that attracts a higher margin. So with that increased shift towards higher margin businesses, we get to that path of the 10%. In terms of, I think the other question was around the double-digit margins for the A&I business. If you just flip back to Graham's target slide, that actually showed we expect to get to high single-digit margins in the A&I business. Look, some of that will come from continuing to drive operational efficiency within our businesses, but some of that will come from increased revenue streams, which allow us to leverage the cost base there.
Okay, great. A question from John. What was the rationale behind the decreased dividend payout? And should I expect a more conservative dividend policy going forward?
So that one, our dividend proposal is absolutely in line with our dividend policy. We have a policy of maintaining cover of 2.5 to 3 times, and we're paying around about a third of the dividend as an interim. So that puts us pretty much bang in the middle of our dividend cover policy. So no change in the policy. Look, the reduction in dividend is really a reflection of the reduced size of the group following the divestment of the defence business.
Thank you, Judith. A question from Richard. Given the variability in the automotive sector, how do you assess the long-term growth potential of your diversification into off-highway, industrial and marine applications?
So look, hopefully covered a little bit in the presentation. Look, we have seen a continued challenge in the automotive, and look, just again for definition, we think about automotive as passenger car, light commercial vehicle and commercial on-road vehicle. And we have seen a pretty steady decline in that over the last few years, hence a very deliberate strategy to diversify into marine, aerospace and defence and commercial vehicles off-road. And actually we've seen pretty good growth in terms of that industrial segment over the last few years, which we would expect to continue over the next few years. So I think a mid-high single-digit growth in the industrial segment is what we're looking at.
A question for you, Judith. Your net debt has reduced significantly by 41.1 million following the RICARDO defence sale. How do you plan to allocate capital moving forward? Will there be further acquisitions or increased investment in the existing segments?
Great. So that the reduction in net debt, reflects the sale of the defence business, doesn't yet reflect the acquisition of E3 Advisory. So we have around 35 million that went out in January on that transaction, and further instalments on the first and second anniversary. So most of that receipt from the sale of defence is already committed to an existing acquisition. Look, there is no change in our capital allocation policy. We're first of all growing and investing in organic growth within the business. We obviously are maintaining our cover in terms of our interest dividend policy. And then, the final area for allocation of capital would be to acquisitions. But at the moment, there is a limited headroom for further acquisitions.
We have two more questions. Recent news from Germany seems to be indicating the possibility of more investment in infrastructure works. Within Europe, do you see order opportunities for Ricardo from Germany if this funding materialises?
Easy answer is yes. Look, the European Union, they had a big conference a week or so ago where they're putting clean energy infrastructure at the heart of the industrial strategy. We are very well plugged into the policy work that will be required to support that, and the business cases to support that, and then also the flow down into corporates in terms of that. Look, the industrial strategy and again from a European perspective, diversification away from just automotive is seen as a very significant resilience focus in Europe. So yes, we see opportunity and very significant opportunity in Europe.
And one final last question. Science Group has built a sizable stake in Ricardo. How do you feel about this, first of all? And how do you think their stake building will play out?
So look, I mean, the first thing to say is that we have a number of shareholders at this type of level. We have a relatively consolidated share register. And look, we will be treating Science Group like any other, big shareholder. Clearly, we are going to engage and have engaged this week, as part of the results presentation. Look, I'm not going to go into, specific conversations, and I wouldn't with any shareholder. But look, we had a first meeting with them yesterday. It was a very collaborative and productive conversation. And look, there's no. We will continue to treat them as any other shareholder.
Many thanks. That is it.
Graham, Judith, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Graham, could I please just ask you for a few closing comments?
So look, thank you firstly for your attendance today. Look, we truly believe that the long-term value of Ricardo is significant. Look, we appreciate that there are some short-term headwinds that have impacted the short term, but equally, look, we've been delivering on the strategy and the stated strategy consistently with the diversification and divestments rather, and the acquisitions. The cost reduction, the turnaround of A&I, and we're now into the next phase as we think about the next wave as we transition the portfolio. So that we have very good confidence in the medium-term outlook. And again, I'd ask that you look through the short-term trend. Thank you.
Graham, Judith, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of RICARDO PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.